This is ShadowQuant Stocks, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 20, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 has slipped to $743.29, shedding nearly 1%, but the real story isn't the index. It's the fracture in the NASDAQ 100. QQQ has tumbled 1.5% to $695.33, dragging the broader market down, while small caps hold relatively firm at $294.04. We are witnessing a clean, painful rotation out of growth and into defenses, capped by a VIX spike to 18.77 that screams caution. Let's see what the data tells us about where this split is heading. Turning to the calendar, we are navigating a quiet day ahead for macro releases, but the corporate grind continues. Today, we have earnings from AGNC, BOCF, CCK, Calx, and AGIS. None of these are household names, but their results will feed into the broader narrative of credit health and industrial demand. More importantly, the market is digesting the post-market moves from AMD and DPZ overnight. There are no Federal Reserve speeches or major economic data drops like CPI or jobs to disrupt the tape today, meaning technicals and sector rotation will drive the opening bell.
With the calendar light, the focus shifts entirely to the structure of the trade. The absence of new macro sharks means the current VIX reading of 18.77 is pure price discovery, a reflection of existing fear, not new catalysts. That makes the breakdown in QQQ self-reinforcing. Traders aren't waiting for news, they're reacting to the chart.
Let's look at the broader canvas. SPY is at $743.29, QQQ at $695.33, and diamonds at $520.81. The VIX jumped 2.4 points to 18.77. Energy is the only green sector at plus 1.16%, while tech is down 1.9% on the day and 5.48% for the week. Where do we stand? We are watching a classic decoupling. The VIX hit 18.77, breaking the neutral 15 threshold after sitting comfortably in the 15.64 to 19.5 range earlier this week. That is a definitive shift from complacency to active risk-off. But here is the nuance. SPY only lost 0.99%, yet the VIX surged over 12% relative to its recent lows. The market isn't panicking broadly. It is pricing in higher risk premiums specifically for growth. The fear is concentrated, not systemic.
And that concentration is visible in the structure. QQQ at $695.33 is testing the absolute floor of its 10-day consolidation range, which starts at $686.76. SPY, however, has a much firmer base at $743.29, with support at $739.51. The data shows IWM holding at $294.04, essentially flat on the week, while QQQ bleeds. This isn't a market crash, it's a tech correction. The technical hierarchy is intact for the S&P but fractured for the NASDAQ.
But grid, you're looking at static support levels in a dynamic stress test. A VIX of 18.77 often invalidates technical floors because margin calls don't respect chart patterns. We have a flat yield curve at plus 0.37 pp and core PCE stuck at 3.41%. That environment doesn't just cause profit-taking, it forces deleveraging. The fact that the energy sector is up 1.16%, while everything else bleeds, suggests institutions are already hedging for a deeper drawdown, not just a bounce.
That brings us to our first deep dive, the NASDAQ 100 QQQ. It's at $695.33, down 1.5% today. Grid, you mentioned the $686.76 level. What happens if it goes?
It's a critical juncture. The current price of $695.33 is within 1.3% of the $686.76 low. If QQQ closes below that, the ascending channel formed since July 13 is invalidated. We move into uncharted territory below the $680 psychological handle. The volume profile confirms this isn't noise, it's active distribution. The 10-day range is $686.76 to $726.39, and we are hammering the bottom.
I agree with the severity, but let's look at the breadth. QQQ is underperforming IWM by nearly 3 times. This tells me the selling is algorithmic and focused on megacap multiples, not retail panic. The put/call ratios in QQQ are skewing heavily protective. Traders are buying insurance, not just fleeing the scene. If $686.76 holds, we might see a violent mean reversion bounce, simply because the downside protection became too expensive for hedge funds to maintain.
Or Pulse, you're assuming there's enough liquidity to absorb those puts. Look at the technology sector. The technology select sector SPDR is down 5.48% this week. That is a structural collapse of momentum. When the leader dies, the laggards die faster. If QQQ breaks $686.76, the liquidity pool dries up instantly. The VIX spike to 18.77 is the spark. The broken technicals are the fuel.
Let's add the fundamental layer. The technology sector is down 5.48%, yet we have AMD gaining 4.7% on news of TSMC Arizona expansion. This is a bifurcation. Capital is fleeing general tech speculation, but anchoring itself in supply chain realities. AMD is the exception, not the rule. The broader sector is suffering from duration risk. High interest rates at 3.63% punish future cash flows. Until inflation cools from that 3.41% core PCE, the fundamentals for generic growth remain hostile.
So is AMD a lifeline or a mirage? CIPHER, walk us through the positioning.
It's a lifeline for selectivity, but not for the sector. AMD's bullish sentiment score is plus 0.64, driven by tangible infrastructure bets, unlike the intangible growth narratives driving the rest of the technology sector. However, looking at the broader earnings picture, DPZ is up 6.9% on strong Q2 revenue. Money is flowing into companies with pricing power and immediate cash flow, like Domino's, not speculative tech. The data shows a pick-and-shovel strategy emerging. Institutions are trimming beta and boosting alpha.
And that brings us to the second pillar of today's action, energy. The energy sector is up 1.16% today and 4.72% for the week. It is the only green sector in the market. SPECTER here. I call this a distress signal, not a victory lap.
Distress signal? The energy sector is rallying. That looks like strength to me. Relative to the minus 1.78% drop in communication services and minus 1.62% in consumer discretionary, energy is leading. Technically, the energy sector is breaking out of its consolidation, while the other sectors are making lower highs.
Look closer at the macro drivers. We have a flat yield curve plus 0.37 pp and sticky inflation, CPI 3.46%. This is the recipe for stagflation fears. When yields flatten and prices stick, growth gets crushed but commodities retain value. The energy sector isn't rallying because oil demand is booming. It's rallying because it's the safest harbor left. The correlation between oil and tech is diverging sharply. As QQQ falls, the energy sector rises. That inverse relationship is the hallmark of a risk-off regime. If this divergence widens further, it confirms that capital is abandoning equity risk premiums entirely.
I'm seeing that fear in the flows. The VIX at 18.77 is pushing traders out of high beta assets. The volume in the energy sector is supporting the move, yes, but it's defensive volume. Investors aren't chasing yield here, they're hiding from volatility. The sentiment data shows a clear flight to quality, or at least, flight to tangible assets.
Exactly, so we have a market split into two distinct regimes. On one side, you have the liquidity trap. The technology sector, communication services, and consumer discretionary are bleeding, driven by high rates and fragile sentiment. On the other, you have the defensives. The energy sector, the real estate sector, and consumer staples are holding ground. The VIX at 18.77 is the bridge between them. If it breaks 20, the trap snaps shut.
Let's look at the third area of focus, the S&P 500, SPY. It's at $743.29, down 0.99%. Grid, how wide is the crack?
The crack is manageable for now. SPY is resting at $743.29, well above its 10-day low of $739.51. The 10-day range is $739.51 to $755.58. SPY is essentially consolidating. It's absorbing the shock from QQQ without breaking structure. Compare that to IWM at $294.04, which is also holding mid-range. The broader market is stable, it's just losing its brightest stars. If SPY holds $739.51, the overall market trend remains intact, even if the components are rotting.
Hold on. Stability in SPY while VIX spikes is dangerous. That's a false calm. When the VIX is rising, SPY's stability usually precedes a catch-up decline. The market hasn't realized yet how weak it is. The 0.99% drop feels mild, but the internal breadth is narrowing. The advanced decline line is likely weakening, even if SPY is flat. Don't mistake the calm for safety.
Pulse is right about the hidden fragility. Look at the financial sector, financials, down 0.86%. Banks are sensitive to the yield curve flattening. If the 10-year, 2-year spread stays flat at plus 0.37 pp, net interest margins get squeezed. SPY might hold, but the constituents inside it, especially financials and utilities, are starting to show strain. The utilities sector is down 0.66%. Even the boring stuff is giving back gains.
And let's not ignore the valuation risk. At $743.29, SPY is still priced for perfection. With core PCE at 3.41%, that perfection is unsupported. Any surprise inflation data next month will force a repricing. The current hold is temporary. The energy sector is rallying because it's an inflation hedge. The S&P is stagnating because it's an inflation victim. The divergence is the key.
Final check on the communication services sector, communication services. It's down 1.78% today, the worst performer. Why is this particular sector taking such a beating?
Because communication services is heavy on the names that have the highest duration risk. Meta, Alphabet, Netflix, they are all tech giant proxies. They sit right in the crosshairs of the VIX spike. Technically, communication services is breaking below its short-term moving averages. The volume is heavy. There is no support structure here until you get down to older monthly pivots. It's a free fall relative to the rest of the market.
Fundamentally, ad spend is coming under scrutiny. In a high-rate, high-inflation environment, marketers cut discretionary spend first. Communication services is the proxy for global advertising cycles. If consumer spending, consumer discretionary slows, digital ads slow. The minus 1.78% drop reflects a downgrade in expected cash flows for these platforms. It's not just a tech sell-off, it's a consumer sentiment indicator.
Sentiment in communication services is deeply negative. The put/right ratio is skewed. Retail traders are exiting these names en masse, believing the tech summer is over. The fear is palpable. Unlike QQQ, where some institutional money is staying put via hedges, communication services is seeing outright capitulation. The sentiment score is crashing.
Capitulation is good for the long term, terrible for the short term. Communication services is the canary in the coal mine. If communication services continue to underperform, it signals that risk appetite is dead. We need to see communication services stabilize before we believe any broader market rebound. Until then, it's a drag on the index. And remember, the VIX at 18.77 makes holding volatile, high beta names like these incredibly costly.
Let's synthesize. We have a VIX spike to 18.77, QQQ testing $686.76, and a massive rotation into energy. Apex, tie it together.
Here is the picture. Pulse highlighted the decoupling. SPY is stable but VIX is screaming risk. Grid confirmed the technical fracture. QQQ is at the edge of its 10-day range while SPY holds firm. CIPHER showed the fundamental driver. Capital is fleeing speculative tech, the technology sector down 5.48% weekly, and flowing into tangible cash flow positive assets like the energy sector and DPZ. SPECTER warned that this is a stagflationary hedge. The flat yield curve and sticky PCE are making growth toxic. The synthesis is clear: we are in a defensive rotation. The VIX spike to 18.77 is the cost of admission for this new regime. High beta growth is paying the premium. The data does not show a crash, it shows a repricing of risk. The question isn't if SPY will fall, but when the energy defense loses its appeal. Until then, the trend is down for tech, flat for S&P, and up for commodities.
3 takeaways from today. 1. The VIX spike to 18.77 marks a shift from complacency to caution, concentrating fear in large-cap growth. 2. The technical break in QQQ below $686.76 would accelerate the sell-off, but SPY at $743.29 remains structurally sound. 3. The rotation into energy, the energy sector, is a direct response to sticky inflation and a flat yield curve, offering a hedge against broader market weakness. We'll monitor the VIX's proximity to the 20 barrier and QQQ's volume profile tomorrow. This is ShadowQuant Equities edition. Thanks for listening. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.